Vanguard is one of the most trusted names in investing, and they try and communicate well to their people who are investing with them and just the world by providing these economic and market outlook updates. Now, this is the mid-year 2022 update, and what they're trying to do is inform us and advise us on what might be wise decisions for us for the rest of this year. So let's go over it and see what it has to say. For one thing, inflation and the government's policy in reflecting that has been a big change. Now, there's a lot of different fingers to point when it comes to inflation, and that's not really the point of this video. The point is to say inflation is here, we're stuck with it, there's nothing I can personally do to change it, so what can we do to effectively work our way around it or have the control that we can actually exert on it? Now, part of that can be trying to understand a global trend, and so they say global economic growth will likely stay positive this year, but some economies are flirting with a recession. And technically, if you follow the news, depending on how you define a recession, we could be in one right now or not. Now, 2 consecutive quarters of negative GDP growth is one of the indicators that people use to deem a recession. Technically, there's more to it than that, but that's one of the big ones. And so some people are saying, hey, we're in a recession right now. It's not the worst one ever, but we're in one. Overall, I try to be a little more optimistic than pessimistic, and so I'll let somebody else who's actually in charge of deeming a recession call it that. We're just very close to one if we're not quite there. Now, as a result of all that, Vanguard has downgraded its 2022 GDP growth forecast for all the major regions, including its inflation forecast. So that was kind of an emphasis for overall, like for the whole world. Now they're going to talk about the United States. For us here at home, inflation is at 40-year highs, which is crazy to even say. And so it means that we're not able to buy as much stuff as we normally could. If we can't buy as much stuff, we're going to slow down economic growth. That's very simple math. That's the way it works. Part of the driving factor of that is that the Fed has been raising rates. And so they expect, at Vanguard, they expect the rates to continue to be raised throughout the rest of this year. Now, if they had to project a final targeted Fed rate, they would end right around that 3.5% area. And then they expect next year, 2023, to also have raised rates that are up there around or even exceeding 4%. Now, it's important to differentiate here because the federal funds rate is not like your mortgage rate. It's not necessarily something that we directly have contact with. That's something that the Fed sets that affects banks, and then the banks have to cover their costs, and so they raise rates on the rest of us for our mortgages and our auto loans and everything like that. Now, at the beginning of this year, Vanguard thought that GDP growth would be at around 3.5%. Now, based on the first half of this year, they've downgraded that expectation down to 1.5%. So that just means they've gotten less optimistic as time has gone on. And basically what they say is that the things that have gotten us to this point, they don't think are going to lift really soon. That even though we've been kind of going through this rough patch for a number of months now, they think that the probability of a recession is about 25% over the next 12 months. And then it gets way worse, 65% over the next 24 months. So that's pretty pessimistic. And in this next section, they go on to talk about other areas of the world. So the European area, the United Kingdom, China, and emerging markets. So in Europe, they've also experienced a lot of inflation, and that's energy prices spiking. There's a lot of conflict happening in particular areas. And so there's energy sources that were being exported from there that no longer really can be. And so it means there's kind of a scarcity. And so that drives the price up. Now, it's kind of a tricky thing because if you have somebody who's in a violent conflict and you just cut their source off, then that's going to create even potentially bigger problems because Vanguard thinks that's going to lead to rationing and recession. So rationing in where you have to really be careful about how we proportion out natural gas or other resources, and it's going to just basically incur a recession right away. But overall, they think that the odds of a recession for Europe are around 50% in the next 12 months and 60% in the next 24 months. So again, like America, better odds than not that a full-blown recession will be happening. Now in the UK, it's not a lot more positive. Inflation's grown there too. They've raised their rates to try and kind of slow things down, but they're experiencing similar stuff to the United States. Now they project that even despite those challenges though, the labor market is going to be really strong. And so that's a great thing for people who are living there. But the fact that inflation is so strong, the likelihood of wages keeping up is really low. And so when they say a drop in real wages, that means that basically the amount of purchasing power you have for doing your job is still going to go down, even though your pay might be going up, because inflation is just so high. And the UK has an overall probability of recession about the same as Europe and similar to that of America. Now, China had some really high growth targets at the beginning of this year from Vanguard, and now they've fallen. They think that now that growth rate will be just above 3%, and that's the driving factor for that projected GDP to be lower. But the interesting thing about China is that the likelihood of a recession there is quite a bit lower. So 30% and 35% over the next 12 and 24 months respectively. That doesn't sound too bad. I mean, a 1 in 3 chance is still pretty high, but it's way lower than for Europe, UK, or America. And then the interesting thing is that even though these challenges have so far been described around these kind of first world Western countries, with the exception of China, the fact is that those same problems are affecting emerging markets too. More than ever, the world is connected. We're a global market, if you will. And so the things that affect some of us end up kind of affecting all of us. And so a similar downgrade in expected growth has been inflicted on the emerging markets as well. Now it's time to talk about the stock market itself. Obviously, the stock market has been hit pretty hard in 2022 so far. I think we're down right around 16% so far year to date. And so that's not great. But they say right here there could be kind of an upside to it. Because of lower current equity valuations and higher interest rates, our model suggests higher expected long-term returns than our forecasts as of year-end. So the updated numbers are a little higher than they were before. Now they're thinking that U.S. stocks are going to earn us 3.4 to 5.4% per year for the next 10 years, which still isn't great, but, it's less bad than it was. International stocks, they're thinking, are still going to do better than U.S. stocks, getting between kind of 6 and 8%. Bonds, they think, are going to be up to 3 or 4%, and then international bonds are going to be right around 3%, 3.5%, something like that. And so what I take from this really is that nothing has changed fundamentally from their previous economic report. Nothing really has changed in terms of what our strategy should be as investors and as people who want to grow our net worth. We can't just be investing in one area. We can't just say, hey, the United States is screwed, let's only invest somewhere else. That even is too many eggs in one basket. We can't say the opposite either. Hey, the U.S. is going to destroy everyone economically, we're going to be the best. And by destroy, I mean outproduce, make the most growth. We can't expect that either. Now, there's reasons to believe that international stocks are going to outperform us, so we can't necessarily fall into the trap of just trying to chase returns. I think the wise thing would be to make sure that we're diversified. Make sure that where these companies are based, that you're doing business with by way of investing, are not just US based. My guess is that most of us need to be more international. Now, I don't know about you, I don't know what your portfolio is like, but for me, most of it has all been US stocks, especially because the weighting of something like an S&P 500, like the top 10 stocks are such a big proportion of that index fund that you end up almost accidentally being really highly weighted in US stocks. And so it means that we might need to do some work to go towards international stocks. I think overall doing that would be a lot wiser, and it would hedge our losses, because even if the US doesn't do so well, hopefully other international companies would. And the interesting thing about that is even that really isn't that hard to do, because all you have to do is pick the right index funds that go towards international stocks or aren't invested in US stocks. And so it's very easy to draw a dividing line down the middle and say, this chunk is US stocks, this chunk is not US stocks. So to learn how to do that, you got to watch this video next, which is my top 5 index funds for this year. One of those is one that just excludes the United States. So it's one and done, super easy. And the secret comment for today's video is boat, because I really don't like boats, but Vanguard's little emblem for their company is a boat. I don't know what that means as far as investing, but secret comment word.